Last week, I ran Huron Consulting Group through 5 distinct valuation models and 2 legendary investor checklists. And honestly, what I found shocked me. Stop what you're doing. If you own this stock, or really any professional services stock, you need to see this 5-model valuation breakdown. By the end of this explainer, you'll know exactly if Huron is a screaming Buffett buy or a dangerous Lynch trap waiting to snap. Now, I know a lot of retail investors are completely terrified right now. Shrinking corporate budgets, delayed projects, it feels like it could wipe out your portfolio. It's a real fear. But here's a totally contrarian reality for you. While its peers are panicking, Huron practically defied gravity. They posted a massive 12.1% year-over-year revenue growth in Q1 of 2026. All right, Section 1, a record-breaking quarter. Let's look at how they pulled this off. This stock's intrinsic value could be radically shifting right under our noses because of one surprising number: $443.7 million. That is the revenue they generated before reimbursable expenses, which completely crushed Wall Street's $437 million consensus. Seriously, imagine a marathon runner casually sprinting the last 10 miles while everyone else is just walking. That is Huron's top-line growth right now compared to this exact same time last year. Now, if Peter Lynch were looking at this, he'd be hyper-focused on how that top-line surge actually flows to the bottom line. And guess what? It flows beautifully. Adjusted diluted earnings per share hit $1.73, easily beating expectations, with EBITDA margins expanding to 11.4%. I promised you a clear, actionable framework you can steal to understand this, and it starts with looking at where the money comes from. Which brings us to Section 2, the 3 profit engines. So, how do they actually make this money? Healthcare is carrying the heaviest load here, making up 51% of their entire revenue base. Education follows at 29%, and the commercial sector rounds the whole shebang out at 20%. But here is the absolute most vital takeaway. All 3 of these segments grew year over year. There are literally no lagging anchors here. All 3 engines are firing on all cylinders. Zeroing in on the biggest piece of that pie, the healthcare segment surged 13.5% to over $225 million. Think about it. Hospitals are basically facing a giant wall of complexity right now. Crushing regulatory rules, insane financial pressures. So what do? They're hiring Huron in droves just to help them navigate the mess and fix their revenue cycles. But hold on, this 12.1% growth wasn't just organic magic. Over the course of 2025, Huron executed a super disciplined M&A strategy, scooping up 6 different companies. Whether it was Eclipse Insights for healthcare or Trellient for the commercial side, these tuck-in acquisitions added almost $20 million in incremental revenue in this quarter alone. Okay, Section 3, the buyback binge. This is where things get wild. In a single 3-month period, Huron bought back and retired 6.5% of its entire outstanding stock. Just think about that for a second. 6.5%. That is an enormous chunk of the company taken completely off the open market in just 90 days. No way around it. That's aggressive. They deployed over $155 million in cash to retire 1.1 million shares. Management essentially said they saw their own stock price dip during the quarter, and they pounced. They actually shifted capital away from buying other companies because they believe buying their own undervalued stock is the absolute best return on investment. And this vividly shows that Q1 wasn't just a random one-off. Over the last 3 years, Huron has executed a jaw-dropping 25% reduction in all outstanding shares. They're basically playing Pac-Man with their own stock. If you are a long-term shareholder, your slice of the profit pie is getting significantly larger every single year, simply because there are far fewer shares in existence. But every strategy has a cost. Let's look at Section 4, cash flow and debt. This is where the core risk lies and what we need to watch. You have this incredibly healthy business with record revenue and expanding margins, right? But look at the liquidity underneath. They reported a deeply negative $162.2 million in operating cash flow for the quarter, while their total borrowings spiked up to $856 million. Because of that massive buyback binge we just talked about, their consolidated leverage ratio climbed to 3.14 times their adjusted EBITDA. Crossing above that 3x threshold? Yeah, that is exactly what makes equity analysts sweat. It's a total high-wire act, using debt and draining cash just to buy back equity. However, when pressed on this, management didn't even blink.
CFO John Kelly stated that Q1 cash flow dips are highly seasonal because they accelerated buybacks to take advantage of the stock price. Sure, the leverage spiked, but they fully expect to generate strong free cash flow and naturally delever back down to a low 2x ratio by December.
All right, moving on to Section 5, investing in an AI future. So where is the future growth coming from? Huron is placing massive bets on artificial intelligence, and they aren't just using AI as some fancy corporate buzzword for their slide decks. They are actively hiring technical talent, developing custom apps, and forming deep strategic partnerships with firms like Hippocratic AI. They realize AI doesn't work in a vacuum, so they are getting hired to physically re-engineer their clients' core processes so these tools actually deliver real ROI. CEO Mark Hussey is incredibly bullish here. He stated that AI and digital transformation will be a significant contributor to future growth and margin expansion. Look, in the consulting space, technology implementation commands the highest premium out there, and Huron is positioning itself right at the intersection of traditional industry strategy and cutting-edge AI deployment. Confident in this roadmap and a very strong backlog of work, leadership has fully reaffirmed their massive full-year guidance. They are projecting between $1.78 billion and $1.86 billion in total revenue for 2026. They absolutely are not backing down from their aggressive growth targets one bit. So let's pull all of this together. We've got a company posting record revenues, retiring a quarter of its stock, and banking hard on an AI boom. But that's all balanced against negative short-term cash flows and spiked debt. So what does this all mean? Is Huron's aggressive capital playbook the ultimate setup for long-term shareholder value, or a house of cards leaning on seasonal cash flow? Run these numbers through your own checklists and let the data decide. Thanks for joining me for this explainer. I'll catch you next time.